Hello, everyone. Welcome back to another edition of the Weekend Charts. Charlie Bilello here. I'm your host, and as always, I'm going to run through some of the most important charts and themes that we're seeing in markets today. And boy, we have a lot to talk about this week. If you're watching this on YouTube, take a moment, hit that subscribe button, hit that like button for more content just like it. What are we going to be discussing today? A lot again going on. We're going to talk about the labor market report, some signs of labor market cooling, why bad news isn't being interpreted as good news by market participants. We're going to talk about the Fed and the unwinding of QE. Will that ever fully happen? The next Fed move, is it going to be higher or lower? The manufacturing and services slowdown, some interesting data points we got there. Undisputed king of buybacks. You could probably guess who that is, but I'll reveal that on today's show. The Amazon economy, just incredible growth from Amazon continuing there. Higher multiples in terms of the S&P 500. I'll illustrate why that's the case. New housing highs, and we'll end, as we always do, with something positive. The fact that it's a renter's market and rents are actually down over the last year. So let's start out with that employment report. Labor market clearly cooling. What are some signs pointing to that? We have a number of things. Start out with that payroll report we got on Friday. 175,000 jobs were created. That was well below the expectations for 243,000 jobs. So just 1 month, you never want to read too much into these 1 months because they're often revised higher or lower. But if we look at the last year, this is really a trend of slower creation of new jobs, 1.8% increase in total number of jobs in the U.S. over the last year. That's the slowest growth rate we've seen since March 2021. And if we look at the unemployment rate, ticked up to 3.9%. And that's the highest we've seen since January 2022. So different market for sure than where we were a year ago in terms of the labor market. We got 3.4% a year ago, which is the lowest that we've seen since 1969. So definitely transitioning to a more normal phase, still well below the historical average for the unemployment rate, which is around 5.7% since the 1940s. And this is an important report we got. The JOLTS report, looking at job openings, actually moved down to 8.488 million. That's the lowest we've seen since February 2021. We've been saying this is likely to come down. It seems to be higher than it actually is. And so this finally is starting to move down here. Of course, we had over 12 million, a record number of job openings post-COVID. People weren't coming back to the labor force after that huge 3 rounds of stimulus. Well, now they're coming back for sure. And another sign of that is the fact that the quits rate has moved down to 2.1%. This is the percentage of people quitting their job. That's the lowest since August 2020. So why is the quits rate going forward lower here? Well, there's fewer job opportunities available elsewhere, so people are less comfortable and confident in quitting their job. Of course, we had a record high in terms of that quits rate post-COVID. So if we're looking at one final reason here, I think this is very important as well. Sign of the labor market cooling, it would be looking at average hourly earnings. They were up 3.9% over the last year, still well above the historical average for going back the last 20 years of around 3%, but lowest we've seen since May 2021. So employees still have the upper hand, but not as much as they did for sure. Definitely a function of the fact that the labor supply and demand is more in balance. We have fewer job openings. We have less pressure on employers to really raise wages when that's the case. So this should likely continue to trend lower. It will be important. The Fed is going to watch this, but you put all these things together, and we clearly have a more normal labor market today than we've had over the past few years. Definitely labor market cooling. So here's the question. Why was this worse than expected jobs report perceived to be good news for the stock market? Why is bad news sometimes perceived to be good news? Well, we saw exactly that last Friday with the S&P 500 up 1.3%, NASDAQ 100 up 2%. You saw a lot of high growth stocks up even more. What were market participants so excited about? Why did they like the fact that it appears that growth is slowing in terms of the labor market? Well, it's that concern about higher interest rates. So coming into last week, you had a lot of people nervous about higher interest rates, about higher for longer from the Fed. And what they saw from that employee report, at least now they're interpreting it as that Fed is going to be more dovish as a result. So what we saw is a pretty meaningful shift in terms of Fed fund futures. Market participants are now expecting 2 rate cuts by the end of this year. So they were expecting 1, now they're expecting 2, and they're also expecting 2 more in the first half of 2025. So we'll see if they end up being right or wrong, but in the short term, that's what got market participants excited. It's often centered around the Fed, this idea that bad news is good news because the Fed will be more dovish. They're likely to ease rates faster and sooner than market participants are expecting if the economy is slower. Now, I would say there's a limit to this bad news is good news phenomenon, and that limit would be when the news gets really bad. So if there's signs that this is not just the cooling of the labor market, but it's actually the early signs of a recession, well, I think then you're going to have the case where bad news is no longer good news. We saw that, of course, in 2001. We saw that in 2008, 2009. And we saw that very briefly in 2020. But 2020, you have to kind of throw out along with everything else just because of about the massive stimulus that we saw both from the Federal Reserve and from the US federal government. So if we're looking at the expectations for the Fed funds rate, what we're seeing here is hold in June, hold in July. Now they're saying the Fed is going to cut 25 basis points in September, hold in November, and cut one more time before the end of the year in December in that final meeting down to 4.75 to 5%. Now, none of this is set in stone. Every single data point between now and September is going to change these odds, change these probabilities. But for now, as it stands today, market thinking the Fed will be more dovish. What I would say is, regardless of what the Fed does, you need a plan for your portfolio. You need a plan for your retirement. And at Creative Planning, we're here to help with that. We're in all 50 states, over 300 billion in assets under management and advisement. So reach out today for a 15-minute call, get a check on your portfolio, get a review, and we're here to help. Go to creativeplanning.com/Charlie for more info on that. So number 3, will the unwind ever happen? This is a big question, and likely answer I think that we got from last week is no, probably not. And what unwind am I talking about? Well, that massive amount of quantitative easing that we saw in 2020 and 2021. Now we've taken away 1.6 trillion in terms of quantitative tightening. So the Fed letting these securities roll off each and every month. But what they announced last week in their Fed announcement, they said we're going to hold interest rates where they are, but we're actually in June going to reduce the pace of quantitative tightening down to around 60 billion a month. It was previously around 95 billion a month. So meaningful difference there in terms of the pace of balance sheet reduction from the Fed. And what's interesting about that is, again, we still have inflation being a concern. We still have the fact that CPI is above 3% and not likely to get below it anytime soon. But yet the Fed is already reducing the pace of quantitative tightening. And this is interesting because we're still 3.2 trillion above February 2020 levels. So to get back to where we were before, we would need 3.2 trillion. It seems unlikely if we're already slowing down the pace of quantitative tightening that we're going to get there. And this is kind of a pattern from the Fed. What they do during financial crises is immediately they provide a massive amount of stimulus. We saw this in 2008. We saw it in 2020. But once the crisis is over, they're very unwilling or unable to move back to where they were before. What's going to be the next Fed move? That's the big question. Apparently, some people were thinking that there was a chance that the next move might be a hike entering the Fed meeting last week. I hadn't really seen many people talking about that, but a lot of people were saying it after the meeting. And when Powell came out and said, I think it's unlikely the next policy rate move will be a hike, the market seemed to get excited about that idea that he's kind of taking it off the table. Now, is saying unlikely taking it off the table? I don't think so. If you get CPI moving back above 5%, let's say, I think you're going to get more interest rate hikes. But I think what he's saying here is if CPI stays, let's say 3%, 4%, then the Fed will kind of stand their ground and still look to cut first. And the question would be, are there some signs that maybe CPI is going to take another march higher? I think a few things to look at. Number one would be this employment cost index, which is the broadest measure of labor inflation. It takes into account benefits as well as wages. And that was a 4.2% increase over the last year, above expectations for a 3.9% increase. So let's say if this stays elevated or even starts to march higher, is that going to push up overall prices to the point where the Fed feels like they might need to hike again? Number two is this interesting relationship that we've seen between ISM manufacturing prices paid and CPI. It definitely seems to be a leading indicator, certainly was in 2020, shooting up here, and then you saw CPI move up with a lag. And when it came down in 2022, you see here the red line CPI following lower. So now we have the highest ISM prices paid since June 2022. We're above 60. So the question is this just a one-off, or are we going to see this be once again a leading indicator of a move higher in CPI to come? And finally, the money supply, which we were saying for the past year and a half, essentially, that this was trending in the right direction. We were seeing slower rates of growth in terms of the money supply. We saw the money supply actually decline 16 months in a row on a year-over-year basis. It's still down over the past year, but you can see here the decline is just 0.3%. And I think likely when we get the April number, we're going to see the money supply actually increase on a year-over-year basis. So the question is, are we going to go back to this money printing regime? Fed's already signaling partially that with their slowdown in terms of quantitative tightening. But if we go back to, let's say, 10% increase in the money supply here on a year-over-year basis, well, that to me would be an indication that CPI could take a move higher as well. Again, this was an important leading indicator on the way up of higher prices and on the way down of lower prices in terms of the inflation rate. So something to watch closely. So will the Fed's next move be a hike? Nobody really knows. I think the Powell comment, it's a little premature in saying he's ruled it out altogether. Of course, it all depends on the direction of the data. If we're looking at next month's CPI report, we're talking about probably 3.5% still. So I don't think that changes anything one way or another. The big question is if we start to push up above 4% and going to 5%, will the Fed feel like they have to do another hike or perhaps another few hikes? Number 5, manufacturing and services slowdown. This is an interesting situation we have where both ISM manufacturing PMI and services PMI were below 50 for the month of April at the same time. And you don't often see that. We've definitely seen the manufacturing slowdown persist here. It's now below 50 for 17 out of the last 18 months. But the service sector has been pretty strong and resilient up until the April reading. So now it's down to 49.4. That's the lowest since December 2022. And we haven't seen both of these below 50 since that December 2022. We weren't in a recession back then, but we were in a pretty bad way in terms of the markets. And if we look at prior to that, we were talking about recessionary periods in 2020. We were below 50 for both of them. And then prior to that, we're talking about 08 and 09 during the recession back then. So if this persists, not a good sign. Obviously, this could bounce back next month. This services PMI taking any recession off the table, but something to watch there pretty closely. I'm sure the Fed is watching that as well. Number 6, the undisputed king of buybacks. Who would that be? Well, you know the answer. That would be Apple. Apple reported earnings last week. And if we look at their revenue growth number, definitely a disappointment, down 4% year over year. It's actually been negative in 5 out of the last 6 quarters. So really opposite trend to most of the other big tech companies, which have been seeing a surge and acceleration in revenue growth. Apple seeing the opposite, down 5 out of the last 6 quarters. A big part of that iPhone growth market seems to be saturated. seeing negative growth rates there. If we look at net income, we actually saw a decline there as well, down 2% over the last year. So the question would be, well, why did the stock bounce 6% on that news of lower revenues, lower net income? Well, Apple authorized a record $110 billion share buyback program, and that got people excited. Apple has been the absolute king of buying back their shares in the last decade. They've bought back $625 billion worth of their stock. You can see here the shares outstanding just going lower and lower here from Apple buying back their stock. That 625 billion in buybacks is actually higher than the market cap of 492 companies out of the 500 companies in the S&P 500, just to give you an idea of how big that is. So Apple having trouble growing. So what it's doing with its massive cash pile is it's buying back shares. And for now, investors seem to like that very much. But ultimately, in the long run, it's going to have to find a way to get back being a growth company, because it's not valued as anything but a growth company. If you look at its valuations in terms of multiples of sales or multiples of earnings, it's still acting as if investors are expecting that growth to come back. And if it doesn't, I suspect it's going to be a disappointment for shareholders, regardless of how much shares it's buying back. Number 7, the Amazon economy. Amazon, just an absolute juggernaut. Everybody, of course, uses Amazon. Almost everybody. You can now get packages same day on so many different items, and people are taking advantage of that. And Amazon continues to increase their distribution on a local level to improve the speed of delivery. And if we look at their revenue growth over the past year, 13% increase. So another huge increase for a company of its size, just absolutely stunning. And its bottom line, Amazon cut costs tremendously, really trimmed down. If you look at net income here, a record over the last 12 months, $37.7 billion. And if we look at operating profit margins here, what we're seeing is, for the first time in Amazon's history as a company, we have above 10% in terms of operating margins. So for a long time, obviously, Amazon lost money or came close to breaking even. Not the case anymore. Now it's an absolute profit generating machine. And a big part of that is the cloud business, the business that most people aren't familiar with or using. A lot of people obviously familiar with Amazon Prime and the retail side of things. But the cloud business has been just an absolute profitable juggernaut of a business over the last decade. Huge growth rates there, and the operating profits there just tremendous. So contributing a big part to that operating margin above 10%. If we look where we were in 2014, 4.6 billion in Amazon AWS revenues, and in the first quarter, if we're looking at a year-over-year basis, 94.4 billion. So just stunning growth. And if we look at that as a standalone company, that 94.4 billion would actually be more than 466 companies in the S&P 500. So by itself, forget about the other businesses in terms of Amazon. By itself, it's just an enormous business, and highly profitable. This is a chart I keep coming back to, and I've been referring to this for years. Eventually, I've been saying this gap is going to be closed. Amazon is going to be the number one company in the US in terms of sales, and it's getting closer each and every quarter. 25 years ago, Walmart was the king. Walmart had 170 times more sales than Amazon. Fast forward to today, it's only 1.1 times bigger in terms of sales for Walmart. And my guess is, at some point in 2025, not this year, but next year, Amazon's likely to pass Walmart in terms of sales. And the expectation for this year at year end is 641 billion for Amazon. But again, 2025, I think it's the year that it finally surpasses Walmart in terms of total sales. And you can see here just the unbelievable growth for Amazon in terms of revenues over the last 20 years since it went public. You're talking about, when it went public, less than $1 billion in sales, and now we're on pace to hit 641 billion for the year in terms of revenues. Just never never seen a company like this in the past, and we may never see this again in the future in terms of such a consistent growth rate and becoming really its own economy in terms of the usage by the American people. So number 8, higher earnings, much higher stock prices equals higher multiples. So here's the math here. Over the last year, operating earnings for the S&P 500 up 5%. That was the 5th straight quarter of positive year-over-year growth. We have 80% of companies reporting so far. So this number could change a little bit, but likely not to change that much. So 5% growth in terms of earnings. And if we look at the trailing 12 month, which is a better way to look at it because we're not just looking at one quarter, we're looking at an 8% increase over the past year. Another record high in terms of trailing 12-month earnings, likely to be with 80% of companies reported. So 8% is the growth in earnings if we look at trailing 12-month. And we have the S&P 500 up 28% over the past year through the first quarter. And what that means is the multiple that the S&P is trading for is going up. So at the end of the first quarter, looking at 24 times earnings for the S&P 500. That's 31% above the historical median, which is around 18.5 since the late 1980s. So stocks becoming more expensive because the run up in share prices outpacing earnings. And so the question for the remainder of the year is obviously going to be, well, is the market foreshadowing higher earnings growth to come? Are we going to see in the second quarter, the third quarter, fourth quarter earnings surprise to the upside? And if it does, well, then of course this multiple can come down even if the stock prices stay where they are, because you're going to have higher denominator, higher earnings. And if it doesn't, well, then you have the case where maybe investors get disappointed if that earnings growth isn't there. Number 9, new housing highs. We're seeing this trend once again. All 20 cities in the Case-Shiller 20 City Home Price Index up now on a year-over-year basis. The 20 city index was up 7.3%, another record high for the month of February. If you look at the national index, it was up 6% over the last year, the 8th straight month where we saw a record high in terms of the Case-Shiller National Index. But in terms of affordability, nothing's really changed there. Kind of the lowest affordability we've seen in history. The reason for that, high mortgage rates, 7.22%, highest we've seen since last November. Of course, a few years ago, we were talking about below 3% mortgages. So a stunning change in just a short period of time. And have this chart here illustrating what this has done in terms of affordability. We're talking now about a 95% increase in terms of the monthly payment you would need to afford the median priced home for sale. We're looking at $2,890 today, $1,480 4 years ago. We continue to hit record highs because mortgage rates continue to go up and home prices continue to go up. So you have the combination of the two leading to what I've been calling the least affordable housing market in history. So if you're looking to buy a home, very difficult time. If you're looking to rent, and we're going to end with this positive note, very different story if you're looking to rent an apartment. And the reason for that is back to that supply demand equation. So we have very few homes available for sale. And most people, of course, finance the cost of a home. So you got mortgage rates making the cost very prohibitive. But if we look at the rental market, supply has been increasing. And the reason for that is we had a huge construction boom in terms of apartment buildings, multifamily buildings in recent years. And that's led to more supply. With more supply and demand staying where it is, well, you're going to have prices moderate. And that's exactly what we've seen in the last 11 months. We're seeing now 11 straight year-over-year declines in terms of the asking price for rents. It's actually down 0.8% over the last year. And this is likely to continue. And the reason I say that is looking at the vacancy rates here. Vacancy rates for apartments, 6.7%, the highest we've seen since August 2020. So this is a leading indicator in terms of pricing pressures. And it's likely to be the case that we're going to see more year-over-year declines. And so with incomes, as we talked about earlier, up 3.9% over the past year. And obviously up a lot over the past few years. Well, the fact that rental prices are not going up, but they're actually going down over the past year and even longer, well, that makes that apartment rent much more affordable. So two different worlds. If you're looking at a home to buy, there's never been a worse time. If you're looking at a home to rent, it's getting better every single month because you have prices staying flat to down and incomes are going up. So hopefully that's a trend that continues. If you look at the vacancy rates, it seems like it will. So we'll end it right there. Thanks everyone for watching the Weekend Charts. If you're watching this on YouTube, again, take a moment, hit that subscribe button. Have an awesome week, everyone, and I'll see you next time on the Weekend Charts.